Thank you for tuning in to another edition of the Vulcan Report. This end of day report is for trading on Tuesday, December the 13th, 2016. And you're looking at a chart of the gold futures. As you can see, we're getting a bit of a cross here on the weekly chart. The shorter term trend line is crossing below the longer term trend line. The longer term trend line is this orange line. Currently, we're at 1160.80 after hitting a low this week of 1152.50. This is, pretty super bearish. But the good news is that this is happening above the cumulus cloud. Price action has dropped below the cumulus cloud, but the trend lines have not. They haven't even gotten into the cumulus cloud yet. They're still above the cumulus cloud. So there's still hope for the market to turn around from here and head back up again. The first thing to overcome would be the momentum resistance, which is at 1189.80. Price a close above 1189.80 this week would put an end to the downtrend and set the stage for a retracement off of the lows. The next stop would be if we can close above 1189.80. The next target is going to be the trend line at 1248.50, and then we would actually put an end to the bear market trend with the close above 1279.60. So that's where we are right now. Everything here is negative. Everything is pointing down in the gold markets, the gold futures. It's just a super bearish chart, and there's no way around it. It's just bearish. The market has just not been able to sustain like it did back here. Tried to rally back up in here for a couple of weeks and then failed miserably. So this is just where we are right now. We can't argue about it. This is where we are. But the thing is, though, we seem to have ceased declining, though, as far as momentum and speed and velocity. This is interesting. We might be at the point where we're going to be putting in a base and a foundation here. So this is going to be interesting. They got the FOMC coming in tomorrow at 2 p.m. Eastern Standard Time. So we're going to see, will they raise rates? Won't they raise rates? At any point, any way you put it, is going to have some effect on the markets. The gold market has factored in a new interest rate rising environment. All right, that's where the prices are right now. Prices have already factored this in. It looks like this is priced into the market, so that's why it's been bearish. So if they don't raise rates, that should help lift gold prices tomorrow. If they do raise rates by a quarter basis point, then we're going to continue the status quo and do what we do. No effect. If they raise it more than a quarter basis point, it could definitely roil the markets and send gold lower, or it could send it higher. See, that's just it. We don't know. And because you don't know what you don't know how markets are going to respond to what you don't know. In other words, markets can rise on bad news. Markets can rally on good news. Markets can fall on good news. Markets can fall on bad news. And any combination of the above. So you just don't know how markets will respond. And because you don't, it's better just to chill and stay on the sidelines as far as putting on any new positions. That's just how you do that. All right, let's take a look and see what silver is doing. All right, looking at the silver futures, totally different picture. Gold's being punished, but silver is hanging in there and moving with the trajectory of the ramps. Here's the first ramp. This one is amazing. This chart gives me hope in the metal space because it's been resilient, and this is what you want to see. This is definitely one to watch and get ready to accumulate and put positions on, because once this thing breaks out, it's gonna lead gold. Right now, silver is leading gold, and if it leads it into the correction and the new leg up, it's going to be massive. So this chart really gives some hope here. So this one right here is all pretty much already there. A close above $17 this week is going to be strong and bullish for silver going forward in the coming week. Let's take a look at the mining sector. Here's GDX. GDX is kind of looking like silver. The only difference is its price action is happening inside the Kumo cloud, whereas the silver's chart you just saw is happening outside the Kumo cloud. But it's the same trajectory, it's the same type of a setup. This is interesting. And here's your ramp coming up. So it looks like the mining shares are going to lead the metal. The gold miners are going to lead gold. That's kind of the way this is looking right now. And so this bodes well for the JNUG. Taking a look at the GDXJ, looking at the juniors. Same story here, and look, we're right here on the ramp as well. So this is looking good for JNUG. It's looking good for Nugget. As far as Dust and JDST, they may be running out of steam based on this, so you got to look and see, because remember, JNUG is going to take its keys off of the GDXJ. Nugget is going to take its cues from GDX. So this is where we are, ladies and gentlemen. This is looking really nice. Depending on what comes out at the Fed tomorrow, this could really get off and going up here. Or it could utterly collapse and fall below the Kumo cloud. We just don't know. Anything can happen. But you got to have your trading plan ready, and you got to follow these pulse waves. The pulse waves will keep you out of harm's way and put you in on the right side of the market. All right, let's take a look now and see what's happening in the dollar space. All right, here's your dollar on the weekly. Same thing, just hanging out above here. Not a lot going on. Looking at the equity side of things, at the UUP. All right, same thing, but looking a little bit better. See, that's why I like equities, because they're better priced than the futures. Look at this. This is telling a different story. There's pent-up bullishness still in the dollar. It's looking like it wants to break back out into new highs. So watch UUP for cues there, because you're gonna know what's what once that happens. And just to show you, let's see, we got a low of 25.80. A low here was 20. So we came within 1 penny of filling this gap here. So technically speaking, this gap really hasn't been filled yet. This is not a fill of the gap. It just looks like one to the naked eye, but it's not. We didn't dip into this space. Therefore, the dollar could still pull back. Not saying it won't go higher, but it could still pull back. But right now, everything is super bullish in this chart. There's nothing bearish on this chart, save the gap that's going to have to be reckoned with at some point. Usually it's sooner rather than later. All right, let's take a look at the black gold space, which is crude oil. All right, still got this spike. Got a spike high of 54.50. So either it's going to crash and burn, or it's going to get giddy up and go here. Everything on the chart is bullish, and it's just trying to determine what it wants to do. And we don't have a lot of price action going on here, so this is just one to watch as well, as for the time being. Let's see our translation into the equity side, looking at DIG. We're no longer looking at UWTI, because that's no longer exists. So we're looking at DIG. All right, as you can see here, let's see, the high of 44.74, low of 44.83. So technically speaking, we got a gap. All right, we got a gap that was not filled. So this could still come down, take out this low slightly. You got until 42.32. So you got an air pocket that needs to be reckoned with, but this one's still looking like it wants to giddy up and go as well. So keep your eye on DIG. Let's see what happens here. Pent up energy still in this market. Let's see if it can giddy up and go, or is there going to be a little bit of profit taken first before the next leg higher? I think this wants to go to at least 50. All right, so that's what we're going to be watching dig for 50. All right, let's deal with the elephant in the room. Let's deal with the Dow Jones futures. All right, we've switched. We're no longer in 2016 December contract. We've rolled over to the March 2017 contract now. So we are in March. Goodbye 2016. We're already in the new year now. And the equity stock index futures. 19,900. We came within 100 points of Dow 20,000. That's right. Let me say that again. We came within 100 points of Dow 20,000 today. Dow 20,000. Remember, it was just Dow 10,000 not long ago. We have 10,000 points of pure Fed fuel injected price bubbling built into the Dow. The Dow's real price is 10,000. That's its real price. All right. Factoring into all things being equal, the Dow should technically be at 10,000. All right. That's based on all the growth and all the things that have happened since 1998. All right, and really you could go back, yeah, I would say 98. Since 1998, the Dow should be around 10,000. Okay, that's where it should be. But what happened? The Fed started pumping and printing money, and they have done enough, so much so it's so massive. We're talking tens of trillions of dollars that is now equated to a $20,000 Dow. All right? Trillions. You're looking at least $10 trillion of Fed fuel injected liquidity into the Dow. Let's say that again. An estimated $10 trillion of liquidity pumped into the Dow. Let that marinate and sink in just for a minute. $10 trillion. We're looking at a $10 trillion Dow, if you were to put it in cash terms. All right? Not stock index terms, which is Dow 20,000. We need to put this in cash terms. It's really not Dow 20,000, it's Dow 10 trillion. You're looking at a $10 trillion Dow. This is what $10 trillion of Fed liquidity buys you, a $20,000 Dow. Keep that in mind, folks. Now, let's take a look and see what else is going on in this space, because it affects our gold, and I'll show you that in a minute. Here is your NASDAQ 100. Doesn't look quite the same as the Dow, now does it? There's a reason for that. We'll get into that. But watch this. Watch the NASDAQ, folks, for cues. The S&P is irrelevant in this situation. I'll pull it up and show you, because it is going to mirror exactly the Dow, down to the penny. All right, it's the Dow. It's the Dow. You don't need to even look at it right now. Let's go to the Russell. Red on the screen, not green. How is that? How is that possible? Watch the Russell. The Russell is saying there's something wrong. All right, so you got to watch it. Now here we took a break and then we broke out. All things being equal, it should be ready to break out in the following 2 weeks. Should break out into new highs. All things being equal, everything on the chart is bullish, right? Everything's pointing up. Momentum's pointing up, right? You even got a ramp right here. But something else is happening in the price action that we cannot ignore. Remember, you had this back here. See, so you had this this bow right here. All right, gotta watch it. In the weeks to come, watch the Russell and the NASDAQ. The reason why you want to watch the Russell is because sometimes the Russell can lead everything, and you got to watch it. Another thing you want to watch is also the Nikkei. Remember, the Nikkei was down for the longest time while the Dow and the S&P and everything was kicking it. Well, now, look at this. It's pointing straight up. All right. It's making a run for these highs back in here. All right. And that was around 2060, and yep, so 2060. All right. Now it's at 19,370. All right, that's what it hit. So 2060, and then back here 2945, 20,945. And then let's see, I don't even think that was the high. Hold on. 20,990 hit on June the 22nd of last year. So the Nikkei hit its high in June of last year, and then it's just been down ever since. And then all of a sudden turns on a dime, and now it's headed way back up. So it fell all the way to 14,990 before coming back up. Now getting close to the 20,000 mark again. Is the Nikkei foreshadowing, and really, is the Nikkei really leading right now? Meaning that it's futuristic. It's leading us. It hit its 20,000, went all the way up, almost up to 21,000, and then fell. Isn't that? Are we seeing parallels to the Dow? Is this telling us that once the Dow hits this beloved 20,000, it's going to keep the Kool-Aid coming up until close to 21,000, and then is it going to fall and correct for an entire year and a half, basically? All right, so we topped out in the Nikkei on June the 22nd of 2015 and continued to do that until June the 20th of 2016. So for 1 year, the market corrected and it lost 6,000 points. All right, so it went from 20,000 to 14,000. So is that going to show? Is that showing us what's going to happen with the Dow? With the Dow, is this leading? Is it foretelling, foreshadowing? And then here we go. And then the Dow finally heads back up and gets back up to 20,000. Is there going to be something to cause a year's worth of bear market? Very interesting. And we have to watch this Nikkei. Now, the reason why I brought up the NASDAQ, because the NASDAQ has not hit 5,000. And I don't mean the NASDAQ composite, I mean the NASDAQ 100. The NASDAQ composite is irrelevant. It always has been. It's the NASDAQ 100 that you have to watch, because back in 2007, 2008, the NASDAQ was not participating when the Dow S&P was hitting new highs. The NASDAQ was not. All right, even now, the NASDAQ has come close to hitting 5,000. It hasn't been to this height since, the late 90s and up into 2000. All right, so we're seeing heights that the NASDAQ has not seen since 2000. So this is very, very important. The NASDAQ has to push and close above 5,000, or at least touch it. And if it touches it, that's a super double top at that point, which could be pointing to a massive correction or a super bear market if it cannot close above 5,000. And it's going to have to stay above 5,000. Technically speaking, 5,000 is going to have to be the new floor for the NASDAQ in order for this new economy, bull market, whatever you want to call it, to really take form and take shape. And then that'll take us to Dow 30 and 40 and 50,000. However, if the NASDAQ does not close and stay and remain above 5,000, then the stock market rally is cursed. It's doomed, and we go into a bear market scenario. For how long? According to this, probably a year. Hey, I don't make up the algos. I just read them. But that's not true either, because I do make up algos. I don't make up these algos. These are not my algos. All right. So I just read it. All right. Hey, take it for what you want. I look at what the market is saying and what the algos are suggesting, and then I run with it. So I'm just giving it to you as I see it. So remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can, give nothing back, and do yourself a favor. Come on over to pulsewavetrading.com and sign up for the Learning Academy, which is free when you register and put in a subscription to the weekly Pulse Wave price triggers, which is a monthly subscription, and we'll get you set up, teach you how to hedge your physical portfolio holdings, teach you how to profit in this paper game, as they call it, and also teach you how to surf the pulse waves. So pulsewavetrading.com. Peace.